In this video, I'm going to talk about Altria, ticker symbol MO. A lot of you have asked me to do another video on the stock, some kind of an update, as it has gone pretty much nowhere since June of 2022. It has been, pretty much flat. The company is now yielding around an 8.5% dividend, so the dividend yield is very, very high. So a lot of people actually say that this stock is a value trap and you shouldn't actually touch it. On the other hand, a lot of people actually like the stock. A lot of dividend investors, they like the 8.5% dividend. They saying that this is the best stock in the world. So there's two different crowds around the stock. A lot of people say it's a value trap. A lot of people love it. In this video, I'm going to try to analyze it and try to determine if MO, which is Altria, is actually a value trap or not. And I'm even going to share a strategy with you that I actually implement with these kind of companies that have a high yield, like MO, like British American Tobacco, maybe Verizon, maybe a lot of those stocks. They are pretty much boring and have a high dividend yield. I have a strategy on it, and I'm gonna share it with you today at the end of the video. Now, if we look at Altria, most of you are familiar with the company. They own the Marlboro brand here in the United States. It makes up most of their sales. They have a 44% market share with the company. They also have other brands and other kind of things. Most of you are familiar with the company. I'm not going to waste your time on it. But as you heard, the company has trying to divest away from those combustible cigarettes to the non-combustible products, into vapes, into a lot of other high growth areas that maybe are not as harmful as cigarettes or whatever people believe. And they invested $13 billion in Juul. I believe this was in 2018 or 2019. I'm sure most of you remember, most of you know the story that the US pretty much banned the e-cigarette, which is Juul, and then they can't sell them in the stores, I believe. And then, the valuation pretty much went close to zero, from $13 billion to zero. The company did overpay, but there was no way to actually tell that this is what kind of the government is gonna do with Juul, which ended up being a very bad investment for the shareholders and for the company in general. And now, Altria is taking another shot at the e-cigarettes and all these kind of non-combustible markets, whatever you want to call them. They recently acquired a new company called NJOY, and this company has a 3.7% market share. Now, Vuse, which is actually owned by British American Tobacco, is 41.5% market share, and Juul was 26.4%, and this was in 2022. So NJOY is a very small company, 3.7% market share. They acquired it for $2.7 billion in terms of how much they paid for it. Now, I tried to determine if NJOY was actually a good deal for MO shareholders or not. It's hard to determine, and it's hard to get any kind of recent sales data on the company, but this is an article from Morningstar, and they said that NJOY generated $14 million in 2021 in terms of revenues. This would put the valuation at 200 times 2021 revenue, which is very, very high. But the company is actually growing very, very fast. They don't have an estimate of how much they made in 2022, but they believe that they could have made around $100 million of revenues in 2022, which still puts the company at 27 times sales. So the most likely outcome is that Altria actually overpaid again for another cigarette kind of e-cigarettes acquisition, and this time it's NJOY, but it's too early to judge. We don't know what kind of regulation could come along. We don't know how NJOY could be integrated within Altria's network. Maybe they can grow the brand, and maybe $2.7 billion was pretty much nothing. This is a payment I believe they got from Philip Morris to break up whatever partnerships they had. So it could end up being an amazing deal, and we're still early to judge. But so far, with the numbers that we have from 2021, they paid 200 times revenues, which is very, very expensive. But again, it's too early to judge, and we have to wait, for a later outcome to actually be able to tell if this was a good deal or not. Now, most of you actually buy Altria for the dividend. The dividend is 8.5%. A lot of people talk talk about a dividend cut. Some people say the dividend is safe. But if we take a look at the balance sheet, the company does have some debt. They have around $26.5 billion of debt. But most of the debt maturity is spread out over many, many years, around 1 to 1.5 billion every single year. And they also have around 3 billion of cash, and they have 20 billion due after 2027. So most of the debt is due, years and years out, which is not a problem in the short term. But in order to determine if the dividend is safe or not, we can take a look at the free cash flow statement, and we could look at the free cash flow and how much they're actually paying in dividends. Now we can see the spread actually kind of narrowing since 2020 and 2022. They collected around $8 billion of free cash flow, and they paid out $6.6 billion of dividends. So there's still an enough margin, around $1.4 billion, for them to do buybacks, to maybe increase the dividend, or to even pay back the debt, which is 1 to 1.5 billion every single year. So I believe the debt is manageable. I believe the dividend is safe for now. They will even likely be able to grow the dividend a little bit. If I was Altria, I would not grow the dividend. I would try to pay back some debt, but they might have problems doing the buybacks that they normally do, because they normally do a lot of buybacks. If you look at the shares outstanding since 2016, they have been coming down, which is something pretty amazing. So they might not be able to do a lot of buybacks like they normally do, just because of the higher debt. But I believe that the dividend is safe in the short term. Now I'm not gonna get into the income statement. Most of you can actually look at it. They declined around 8% in terms of net income. This is not a good sign at all. So the company is kind of flat to declining in a lot of those sales ventures. But in my opinion, if you're buying Altria today, you're most likely going to get the same exact return as the free cash flow yield of the company. If we don't have a further multiple contraction, which is very unlikely because the company is trading at record low multiple. If we don't have further kind of increase or decline in sales, I don't believe so. I think sales will most likely be flat. I don't know how Enjoy is going to affect this whole thing, but if sales and net income pretty much stays flat, you're most likely going to get the 10.5% free cash flow yield that the company is actually trading at is mostly going to be 8.5% from dividends and maybe 2% from buybacks. The total would be around 10.5% every single year, outside of any major sales decline or outside of any major kind of multiple contraction. But what I like to do with companies like BTI, like MO, which I believe BTI is better than MO in my opinion, because BTI has more international exposure. If any kind of say something happened with regulations in the United States, MO is going to be affected much more than BTI will actually be affected. They also own Views, which is a massively growing brand in the e-cigarettes and vaping and a lot of other things. So I think BTI is actually better than MO in my opinion. But what I like to do with these stocks normally is I like to buy them and sell covered calls on them in the future. And this is for very good reasons, because if you look at the stock, for example, since August of 2022, the company is very, very predictable. It goes around 47, 48, and then it goes back to 43, 42. So what I would do if I was to buy MO today, I would buy it and I would sell covered calls in the future. And if you would maybe collect 5% every single year selling those covered calls, and you add it on the 10% free cash flow yield, this is around 15% every single year. And if we do have sales decline, or if you have a multiple contraction with this whole company and the company goes down, so because you sold the covered calls, you can actually buy them back much, much cheaper, and you could collect the difference between the premium, and then when the company goes up, you can go and do it again and again and again. So this is what I do with these kind of companies. If I was buying MO, BTI, Verizon, you might miss some upside if the company and the stock goes up, but you're most likely buying MO not for the upside, for the dividend. So you could collect the dividend, collect 4 to 5% on top of it, just for doing the covered calls. If it goes down, you could buy it back cheaper and then sell it again when it goes up. So this is what I would do if I was to buy MO today. It's hard to determine if the company is a buy or not on itself, because the dividend is well covered, but we don't know what kind of lawsuit we could have, what kind of change in regulation, so it's a very hard stock to actually buy with any kind of conviction, especially from the concentration within the United States. As I said, I would prefer BTI because it's more international, much more diversification in terms of brands and many other things. But if I had to buy BTI or MO, I would collect the dividend, maybe get the free cash flow yield, which is 10.5%. I would collect another 4 to 5% selling covered calls, and this way I actually have my downside protected. So thank you for watching this video. I hope this was helpful. I hope you enjoyed it. If you did, please press the like button and maybe consider subscribing. So I hope to see you in another video.